Hello Accounting 101 students. In this video, we're going to go over the financial statement handout. And this handout is found in Chapter 1 in terms of our course materials and is basically a summary of the 4 financial statements, just providing some simple examples. The first financial statement a company prepares is the income statement. And this income statement is prepared for a period of time. So we're going to be preparing this for the month of October. So October 1st until October 31st, we want to report our revenues and expenses for that specific period of time in order to arrive at the net income, which tells us about the profitability of a company. So the income statement first starts off by listing the revenues. And we always want to list out all of the revenues that a company has, typically from largest to smallest when it comes to your assignments in Wiley Plus. So if you have sales revenue and service revenue, you would list both of those in the revenue section and come up with your total revenues. The next section is on expenses. So each company will have different expenses. But for the purposes of Wiley, in Chapter 1, you want to list your expenses from largest to smallest. And you can see that there is a subtotal for the total expenses. The main thing that you want to get from this income statement is the formula for net income. So for the income statement, the formula that you want to note or write down is total revenues minus your total expenses equals your net income. And if your expenses are more than the revenues, you'll end up with a loss. You'll also notice that you do not need to include in any negative signs because the word expenses is telling you what is going on with the account, that the amounts are going to be deducted from the revenues because the expenses are a cost. So please keep that in mind when it comes to formatting. The next statement that a company prepares is the retained earnings statement. And the retained earnings statement is also prepared for the same period of time. So it's prepared for that same month of October. And the retained earnings statement shows the amounts and causes of changes in retained earnings during the period. So when it comes to the company's profits, a company is not going to distribute all of their earnings. They're going to retain some of their earnings for future periods. So for our retained earnings statement, we always start off with our beginning retained earnings at the beginning of the month. So we're going to start off with October 1st, which is the prior month's ending. When you have a brand new company, you'll start off with 0 retained earnings. But if you have a continuing company, 1 month's ending is the next month's beginning. From there, you're going to add net income, and the net income amount you can see matches with the amount in the income statement. So you have the exact same amount that's being used for the retained earnings statement. From there, you're going to subtract out dividends, and dividends are distributions to the stockholders. When an investor gives money to a business, in exchange, they're going to receive shares of stock in that company. A company may choose to issue dividends to their investors by taking a small amount of the earnings and giving it back to the investors. And that's referred to as dividends. And one important thing to note about dividends is that dividends are only showing up on the retained earnings statement. The last statement that we have, or the last part of this statement, is our ending retained earnings. So our ending retained earnings is for the end of the period. So now we're going to write down the formula for the retained earnings statement. So you're going to start off with your beginning retained earnings. So the beginning of the period. You're going to add the net income, which is coming from the income statement, minus any dividends that a company may have. You might come across some problems where there's no dividends. You'll just enter in 0. And then you're going to have your ending retained earnings. And these are the first 2 financial statements that we're going to be talking about. Okay. So next we're going to be talking about the balance sheet. So the balance sheet is the 3rd financial statement that a company is going to prepare. And the balance sheet is prepared right after the retained earnings statement. So I'm going to put these formulas on the side. That way you have them. So the balance sheet. You'll notice that the header indicates that this is prepared as of a specific date and time. It is prepared for a specific time period. So this is as of October 31st, and the company has a cutoff time on October 31st. Maybe it's 6 o'clock p.m., maybe it's 11:59 p.m. But the balance sheet provides us with a snapshot of the company's financial position at a particular point in time. And what we want to understand is the company's assets, all of the resources that they have, compared to their liabilities, which are the amounts owed, and the stockholders' equity, which is the owner's claim to the business. And the assets need to be presented in the order of liquidity. So we always start off with our most current assets, which are going to be cash, accounts receivable. If there's inventory, it will probably be listed next. Then we have supplies and prepaid insurance. Those are common current assets. Then we're going to list our long-term assets, such as equipment and other property, plant, and equipment that we plan to use for several years. In the liability section, we note the amounts that we need to pay to others, the amounts owed to others. And this is also going to be in a particular order. It's the order where the amount is due. So it depends on when the amount needs to be paid back. So sometimes the notes payable will be due at the beginning of the next month, so November 1st. Then you might list notes payable first. Then you'll have accounts payable, and then you're going to list your other liabilities depending on when you need to pay it back. In Chapter 2, you learn about the current and the long-term portions of notes payable, which is another word for a loan. If you need to pay back that loan soon, within a year, it will be classified as current. If you need to pay it back longer than a year, it'll be classified as long-term. But basically, most of your liabilities are going to have the word payable, which means that you owe amounts to other. The exception here is the unearned service revenue, which essentially is an amount that the company receives in advance from their customer prior to providing the good or the service. So in essence, the company owes the customer the good or the service, or they need to give them a refund. Okay? And then in our stockholders equity section, we have 2 main parts of this. We have our common stock, which is the amount that is given from the investors in exchange for ownership of the company. And then we also have retained earnings, and you'll notice that we have our ending retained earnings on the retained earnings statement, which is used for the retained earnings balance on the balance sheet. And one of the key relationships that you want to notice is that the total assets is going to be equal to the total liabilities plus equity. The formula that you want to note for the balance sheet is also referred to as our basic accounting equation, which is total assets equals the total liabilities plus equity. So that will be the formula that you want to note for the balance sheet, which reports the assets and claims to assets at a specific point in time. Last, we have our statement of cash flows, and our statement of cash flows is covered later in our semester, but basically the main information that you want to note is that the statement of cash flows has 3 main sections. And right now in our semester, you only need to know what are some examples of operating activities. What are some examples of investing activities? And what are some examples of financing activities? And you want to read through our textbook all of the examples of business activities and how they're classified, because in our statement of cash flows, we're going to try to explain the sources and the uses of cash during the period. So this is the same month. And we want to get to our net increase in cash during that period of time. And basically want to know, how did we get cash? How did we use cash? And at the end of this statement of cash flows, this needs to match or reconcile to the cash balance on the balance sheet. So that is the relationship between the statement of cash flows and the balance sheet. Thank you for taking the time to watch this video.